Welcome to Commercial Real Estate Pro Network CREPN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is Trevor Crow, founder of Crow Legal LLC. Trevor founded Crow Legal LLC to deliver sophisticated and practical legal solutions for companies looking for an alternative to a large law firm. His focus in business transactions include complex joint ventures and syndicated real estate deals. And in just a minute, we're going to speak with Trevor about real estate joint ventures. But first, a quick reminder. If you like our show, CREPN Radio, there are a couple of things you can do. You can like, share, and subscribe. And as always, we would encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. And you can find us on YouTube at Commercial Real Estate Pro Network. And I'd like to encourage you to subscribe there as well. With that, I want to welcome my guest, Trevor. Welcome to CREPN Radio.
Hey, Darren. Thanks for having me.
You bet. I am looking forward to our conversation today. But before we get started, if you could take just a minute and share with the listeners a little about your background.
Sure. So I grew up in the Denver area. I'm still in Denver now. That's where Crow Legal is based. And I went to law school at DU, Denver University, and graduated in 2009, which was not a good year to graduate law school. It was right in the downturn in the economy, and law firms weren't hiring. And so, I had to deal with that initially. And I really think that's a big part of my background, actually. That's why I mention it. And came out then and, had the firm I was supposed to go to kind of had to retract the offer that I had because the work was just so slow, especially in the transactional area. But anyway, they ended up bringing me back there. And long story short, I bounced around to 3 different law firms in Denver, mid-sized law firms, from 20 to 50 lawyers, and made partner at one of them in 2017 and was a partner there for a year. And then I decided to, and that was mainly a real estate firm. And so that's kind of where I got a lot of my real estate experience, and then ended up in February of 2018, jumping out on my own, starting Crow Legal, and did that. And since then, we've kind of took off and kind of a boutique transactional firm in Denver, doing deals. We do deals all over the U.S., but focusing on real estate joint ventures, syndicated real estate deals. We represent both investors and promoters and developers. And so I currently have 2 other attorneys that I've hired since I started the firm, and now we're a 3-attorney shop and just trying to make our way.
Well, congrats on surviving the start in the market you were in, and pulling the ripcord and going out on your own. I know that's always a thought a lot of people have, and to actually do it is a whole nother thing. So congrats on that. So
thank you.
So real estate, you mentioned your background and what you learned there at the firm where you were made partner. Can you describe kind of the breadth of types of transactions and what you were doing with real estate?
Yeah. So, typically, again, we're representing either the investors or the developer or promoters in a real estate deals. And so, really our focus is not so much on the purchase and sale agreement and locking up the property. A lot of times what we're drafting is all the entity documents. And so we're doing the operating agreements. And when I say syndicated real estate deals, I'm talking about ones where, there's a developer who's going to have to raise part of the equity. Usually a real estate transaction involves a bank loan, which covers part of it. Then there's going to be equity that they developers or investors are putting in. And so a lot of times developers don't want to put in all their money into the one project, or either because they don't have all the money, or even if they did, they don't want to sink it all into just one project. They want to do several projects. And so they go out and they find investors. And so with that, they have to raise the money and comply with securities laws. And so we'll draft all the securities documents, we'll draft all the entity documents, and we'll help navigate all those. And the joint venture agreement, or what I call a joint venture agreement, typically in the form of a operating agreement for an LLC, that is the buyer of the real estate, is a very complex document depending on the parties involved and that sort of thing. And so we've really carved out a niche in being able to draft those operating agreements and represent either the seller, or either the investors or the promoters on those deals.
Gotcha. And you mentioned joint venture versus syndication kind of thing. Can you distinguish between the two structures, or what the difference is?
Yeah, it's kind of one and the same, honestly. What I say joint venture is because, at least in my world, there's attorneys who say they can draft operating agreements for, draft an LLC operating agreement. So somebody forms an LLC in whatever state. What governs that LLC is the LLC Act, as well as an operating agreement, which is what is put together to kind of govern the management, how the economics work, distributions, allocations. All that is built into the operating agreement. And an operating agreement for a business, say it's an engineering company, and there's three engineers who get together and they want to start an engineering company, and they could form an LLC, and there could be an operating agreement for that. But that operating agreement is going to be very different from what I'm calling a joint venture operating agreement, one where there's somebody who's managing the deal, the real estate project. So again, probably a developer, or just a value add sort of real estate person, somebody who's going to go and lock down the property, get it locked in a purchase and sale agreement, and is going to manage the property, either develop it from ground up, or is going to do some value add renovations to it and get it leased up, or whatever they're going to do. And so there's that party, but they also may have to go out and get equity from other people, so other investors to come in and put money in so they can close on the real estate. And so when I say syndicated deal, it's any sort of deal where they're going out and getting investors to invest in it.
Okay. We're like passive investors as opposed to active kind of thing. Okay.
Right, exactly. So it's going to be, the manager or the general partner who's controlling all the operations, but there's going to be limited partners, or just passive members of the LLC that are investing money in the project and want to get a return. They get usually some sort of preferred return and return of capital, and then there's some sort of split after that where the developer gets all their money because they sell the project for a big profit 5 years from now.
Right. Do you tend to deal in more of like development projects, or a lot of I think the common term is value add, guys that are buying an existing property, they're going to go in and renovate some, increase rents, increase the NOI, the value, and then liquidate. Is there any, do you do one more than the other, or is it kind of, can you describe your
the allocation of practice there? So it's probably 50-50, honestly. Right now, at least, we're doing working on several ground up development deals. And so buying raw land and developing it, which adds a whole new element to it, because you have the whole entitlement and permitting process and things like that, and more agreements involved because you have general contractors that need to be hired and that sort of thing. But we also do a lot of just the value add type projects where it could be in multifamily, buying an apartment building, or it could be an industrial warehouse, or it could be just retail commercial properties, and so that are existing, and they're just trying to like you said, either do some renovations and increase rent, or get it leased up and be better at marketing it, or something like that, and then flipping it later.
Gotcha. And for the key principal, the party that's sponsoring the deal, can you walk through some of I guess the risk and the benefits of working on a deal like this, as opposed to taking it all on themselves, or maybe not going out and finding investors? I guess I'm trying to differentiate between the opportunity, the risk reward of the model of going into this with a joint venture syndication model. Does that make sense?
Yeah. So I think the risk reward from the developer side is, if they're putting all, well, one, if they're putting all their money into it, because typically a bank's not going to provide 100% financing. So, then they've kind of put all their eggs in one basket. But on the back end, what if you bring in investors? One, you have to deal with them, and so they may have certain rights and major decision rights or things like that they're negotiating, and they may have misaligned interest in that they want to sell the property at a certain time versus when the developer wants to sell it, and things like that. So you certainly have some push pull there and potential risk with just having other people involved in the project. Now, the other thing from the economic standpoint is, how the distribution waterfalls typically work, at least in the deals that we've been involved in, is, it's gonna, you have the property. Let's just say it's a multifamily existing property, and they're gonna be collecting rents. As soon as they buy it, they're gonna start collecting rents, and so they have money coming in, and that cash flow usually goes out first to pay the investors. And so maybe the sponsor of the project takes a management fee as part of it, and so that's kind of how they stay afloat. But really, their big payday comes at the end of the day when they sell it, because hopefully they've added value, they've leased up the property, and now they can sell it for a much higher price than they paid for it. And at that point, the money flows out first to the investors to give them all their capital back, 11% on their money for the time period that they've owned it. And then the money usually split in some sort of 80-20 fashion or 70-30 fashion, where 80% goes to all the investors or anybody who committed capital or made capital contributions to the entity, and then the rest is coming out as a promote to the developer or the sponsor. And so that 20% or 30% they get on the back end is really their payday. And so they're kind of taking a risk that their big payday for all their work doesn't come out until the end of the day.
Yeah. No, the cycle of the deal, I appreciate you kind of going through that, because I think a lot of people get kind of wound up in the passive investor side of things, not really talking about the sponsor side of what they stand to gain, but also that their interests are aligned with their investors. I mean, if you don't satisfy your investors, I'm assuming you're not going to make your money, right? I mean, the investors are in line ahead of you as far as getting their return. I mean, you get your little management fee along the way. Like you said, it's kind of something to sustain you, but not necessarily the big win that everybody's looking for.
Right.
And in your experience, what's been like a typical hold period for some of these properties?
So the whole period has varied, but usually I see where everybody is trying to have some sort of either 5 to 10 year period of when we're going to try to turn the property around. Now, different sponsors have different theses on the property and theories on when they're going to do it. And so some think that it may happen earlier, and try to push for that, try to do a quicker sale in 2 to 3 years. But usually I would say most investments are in the 5 to 10 year time frame.
And as far as the size of deal, what can you give us a range of the purchase and the capital raise, kind of a range of size of deals that you've worked with?
Yeah, so we've kind of gone across the board on that. So we've done a $90 million real estate fund, and worked on that, which was obviously doing multiple properties. And we've also have a lot of clients that are just kind of the side hustle mom and pop real estate investors that are going out, but they have friends and family who contribute and invest money in these projects, and so they're just buying an office building for $1 million or something like that. But usually it's in that range, I would say. I mean, just real estate prices have gone up, so real estate in general is expensive. But most of our deals are kind of in that, I would say, $1 million to $10 million range.
Got it.
And that's total purchase price. So sometimes the investors that they're getting, are on the fund part, they were actually raising $90 million, and so that was a big one for us. But in a smaller one-off project, it's they could be raising anywhere from $250,000 to $1 million.
Gotcha. Um, talking about kind of the financial risk reward there that we were talking about, have you had any issues or any stories where you've had kind of a mutiny or where the investors have been so dissatisfied that they've sued the sponsor, or any kind of tales like that or some cautionary tales that you can tell of things you've seen? I mean, I'm sure that your documents are set to where, if this happens, this is where you go to. But I know that that's always the plan, but reality can deviate from that. Anything that you can share with us?
Yeah, certainly. So, yeah, and it's come up, and a lot of times it's the time frame question where investors want to sell and get their money out, and the promoters don't want to sell at this time, either because they think the market's going to turn and for the better, or if they had a little bit more time, they could get a better rate. And the thing to consider there is, from the investor standpoint, if the project would sell for enough for them to get their capital returned and the preferred return, some percentage on their money that they've put in, they may be okay with the sale. But the promoter hasn't, they only get paid if it's just enough to return capital and the preferred return, then they don't get that big payday at the end. And so their incentive is to keep it and hold it and hope to get a higher price, because that's where they make all their money. Whereas the investor may say, well, we don't need to even get to that split yet, and let's sell now and cash out. And so that's come up. And often in these joint venture agreements, there's a major decision rights, and major decision rights usually require these are the big items, taking out more debt, selling the property, entering into affiliated a contract, something like that. And so that can be a point of contention down the road. And so we always like to make it clear on who can make that decision and when in these joint venture agreements. The other thing I would point out is, typically there's ability to remove the promoter. So if the promoter and take away their promote if they do something bad, it could be usually included in that is, fraud, gross negligence, things like that. And so obviously if they commit that, then the investors can remove that person as a manager, take away their promote, and, theoretically at least hire somebody else to come in there and manage the project. And the issue with that sometimes is we had a deal before where there was the principals of the developer or the promoter company were really good people. Unfortunately, they hired somebody who was maintaining the books, who was skimming off the top, and so technically the company had committed fraud. And so luckily we had investors in there who were friendly enough not to remove us as manager or my clients as manager and take away their promote. We did have to reimburse the company for the amount that was stolen, and obviously went after the bookkeeper who was skimming off the top. But there's technically that was fraud, and they could have been removed. And so something to be aware of that, if you're running a a larger operation and you have employees, that can lead you into a really bad situation. Luckily, in all other respects, they'd been managing the property very well and doing all the right things. And so, the hiring mistake didn't lead to them actually losing it, but something to be aware of there, too, which I've seen.
Yeah, it's always scary, some of the schemes that people cook up. I know my dad was a banker, career banker, and occasionally when I didn't have any funds to do something over break, he'd say, "Hey, you want to get a job in the bank?" I was like, "Oh, okay." And it'd be a few months later, and he'd go, "You remember so and so? Yeah, I started. I caught him stealing." And and be at dinner or something like that. And it was always some elaborate little scheme. How they came up with it, but it's you know it happens quite a bit. So you mentioned the investors want to sell, the sponsors not ready to sell. Is that kind of the more of the focal point of issues you've seen? I mean, I know you mentioned if the operator is not the operator commits fraud or whatever, they can be taken out. But as far as I'm just looking for, or I guess I'm asking about just anything friction that comes from the investor side. I know once if it's you and me, we can probably agree on a lot of things. We bring somebody else in, all of a sudden now we got a third person, and then you just continue to multiply that Rubik's cube to where it's not always easy to get everybody on the same page, or you think they are because they signed all the documents that to enroll in the deal. But I'm just kind of curious, any other points of friction that you run into or have you seen?
Yeah, and another big one I would say is additional capital contributions. So, if the idea of the project is we're going to go in there, we're going to renovate and do some things, and it's going to help us increase rents or whatever it is to add value to the property, typically there's a budget that's put out, right, and says here's what it's going to cost to do all this, and this is why we're raising this money. And it's hard to put together budgets because they're not always correct. And so the investors usually want to put in their money and they don't want to put in any more. They said, this you've told me this is the budget, this is the project. I'm investing this amount of money and I don't want to put in any more. But that can put the promoter or sponsor in a bad position, because if they don't hit those budget targets and they do need more capital, then what are they going to do? They either need to put in the money themselves, or they need to get more bank financing, which is is hard to do, and or they need to go back to the investors. And so this gets negotiated in most of these agreements, and it's kind of a point of contention on whether they can or can't force the investors to make additional capital contributions. And it kind of is a negotiation that goes back and forth. But even in the case where there is required additional capital contributions to either cover an operating deficit or a development cost deficit or overrun, then a lot of times they can lead to friction between the investors and the sponsor, and in that the investors are saying, what happened? You had this budget. How come we're off? Why are you asking me for more money? And no matter what the document says, there's still that friction that's created in potential disputes between the parties there. That's uncomfortable to navigate. So we always try to make sure that when we're representing sponsors, especially first time people who are doing this, to make sure they have enough either additional capital themselves or additional line of credit with a bank, or they have built in enough buffer in that budget to say there could be cost overruns here on some of these things.
No, I know a number of my projects, they've all I don't know that anything's ever come in under budget or time. Those are, what's that old saying, good, cheap, or fast, pick two.
Yeah.
And so I think the especially with, I would tend to believe that'd be a bigger issue with a lesser experienced operator, because I'm guessing that your more experienced operator has learned that lesson. Also, I would guess it would make it difficult to go raise capital if that's the rumor on the street is the project you did. I mean, the people that you had in the first deal probably aren't going to sign up to do a second deal if
Right.
that's your experience base. So that's good to know. So from a passive investor standpoint, what are some things you can point to that passive investors should look at or be aware of when engaging in a um, joint venture or syndication, as far as uh, the agreements or the operator? Are there any kind of things you can point to?
Certainly. Yeah. So a lot of times these agreements get drafted, and investors don't really pay much attention to it, depending on, obviously if it's a big institutional investor or just a big, investor who's putting in a lot of money, they're going to do their due diligence more than if you have a round, you're raising money and you're getting it from small amounts from 20 different people that are all friends and family. They may just be buying into the person as opposed to the project, so they're not paying attention to the documents as much. But the big hammer that I think, if you're a passive investor, that you want to kind of have on your side is, one, that there's budgets that need to be approved. And so the budgets come in the beginning, and an annual budget comes every year, and it's approved by the investors, or a certain percentage of the investors. And so that's one big thing. And then that kind of ties to a lot of other decisions, so the manager or the promoter can't really make a lot of decisions outside of the budget. If it's in the budget and it's been approved, they make those decisions. If we start getting outside the budget, then they have to go back to the Class A members for approval. Also, sale of the project, approval of that by the Class A members, or I'm sorry, I say Class A because a lot of times the investors come in as a separate class, but really just the investor members have the ability to approve a sale, or it has to be brought to a vote of the members to approve a sale, and a certain percentage of those investors have to vote for it to happen. Those major decision rights are really the big ones that a passive investor should look for, so that there's not just a unfettered ability for the manager to do, or promoter to do whatever they want. And I keep going back on these terms. Sometimes people call them managers, sometimes they call it a promoter, sometimes they call it a sponsor. I'm using those terms synonymously as the same thing. It's really the person who's kind of bringing the deal to the table and going to be managing the project.
Yeah, understood. I appreciate you clarifying that, because I know I think I'm pretty clear on that, but I know that it's easy to get kind of mixed up on who's on first and what's on second, and you realize they're all the same or whatever. So in the spectrum of doing a deal, if there's an investor out there that wants to um, do a project, raise capital, um, you know, get their ducks in a row, and go out and do a project, and be a developer, or be a deal sponsor. Um, are there some checklist items that you can point to that you recommend that they, whether it be time, experience, resume, um, any of all of the above? Is there a list when somebody calls you up and says, "Hey, Trevor, this is what I want to do"? Um, is there a kind of a list of things you can recommend they be ready for?
Yeah, I would say, one. So what happens, and I'll kind of approach this question in a little different way, but I often get calls from people who say, "Hey, we want to do real estate deals, and we want to, and maybe we've done a few in the past and been successful, but now we want to do it on a bigger scale, and so what we want to do is raise a fund. We want to get a bunch of capital in, and we're going to go chase deals, real estate deals." And a lot of times they say, I say, "All right, do you have, properties lined up or in the pipeline or locked up with a purchase and sale agreement, or at least an option or a term sheet?" And they say, "No, we just want to raise the money and then go look for them." And and inevitably that fails unless you're, a big institutional real estate company that has a long track record. It's really hard to raise money unless you have a specific project, because investors just say, hey, show me what project you want to invest, you want to what the project is, and I'll decide whether I want to invest or not. Not many people want to make a capital commitment or an investment before they see that. So this blind pool fund idea is very hard to pull off. And so, I think a lot of people get that idea in their head, and it's a lot tougher than you think, just because investors aren't going to put up the money. So that leads to the answer to your question, I think, is one, have an idea of the properties that you're looking at least have a pipeline of properties. But at the same time, it's kind of a chicken and the egg thing, where you have to also have investors lined up, or at least, soft circled somewhere that have said, yeah, we're interested if you find a good deal. And so you want to have those relationships in place, because if you find the project first and then try to start making those conversations, it's the timing gets tough. So you're kind of doing both of those at the same time. You're looking for deals. At the same time, you're talking to investors, telling them kind of what you're looking at, what you're thinking about, and getting people excited or interested, and so that you at least have a few people that you have on board, that as soon as you have that project in the door, that you can send it to them and say, hey, what do you think of this? And so that's important. Having an idea of the budget is important, and something to think about from the beginning. Having your team lined up, I think you want to have. You got to move quickly on these things. So you need a real estate lawyer to draft the purchase and sale agreement. You need a corporate lawyer or somebody who does entity documents like me, to help with the finding or putting together the operating agreements and investor documents that go out. Having a good description of your track record, any sort of bio on your history, that's important to investors. All those things I think are important to think about and kind of have. I know those are more general than kind of a straight checklist, but those are the big things I think that somebody who's trying to put together and take in investments and do real estate deals needs to consider before they're doing it.
No, I appreciate you taking us through that. I think there's always this notion, if you have the deal, the money will follow, and I've heard that if you're at a standing start, or if you're at a stop and you're waiting to start until you have the deal, you may have waited too long. So I mean, kind of like you're kind of putting the feelers, like you mentioned, it's kind of like a juggling act. You're trying to stay in communication with potential investors and let them know kind of what you're looking at, but before you get the formal offer, I mean, have a property in mind and kind of a direction, because it seems like the clock starts run. I mean, as soon as you sign the documents, the bullets are live kind of thing. It's no longer Nerf kind of thing. It's the real thing. You've got timelines and money, and if you don't meet those timelines, there's real money on the line, kind of thing. So I appreciate that. If we could, Trevor, I'd like to shift gears here for a second. I mentioned to you before we started that by day I'm an insurance broker, and I work with my clients to manage risk and assess the risk and determine what to do with it. And there's a couple of different strategies we typically consider. The first is, can we avoid the risk? If we can't avoid it, then we look to see if there's a way to minimize the risk. And then lastly, if we're not able to do the minimize or avoid, we look to transfer the risk. And I like to ask my guest if they can identify what they consider to be the biggest risk. And, basically take a look at your operation, your customers, you can frame it however you want to. And again, for clarity's sake, I'm not necessarily looking for an insurance related answer, but if you're willing, I'd like to ask you, Trevor Crow, What is the biggest risk?
So in my mind, that is assuming that there is no risk in certain actions and or in the status quo. So, for me, I started this firm, which seemed like a big risk at the time. And I started it in 2018, but because I was coming from a firm, a well-established firm that, paid me, and I was, never worried about the paycheck, and it just came. And I knew there was business there, and this business was going to keep coming in. And so it seemed like a big risk for me to go out on my own. Now I look back at it, and I think I was at a much bigger risk staying at that firm than I am now. And it kind of goes back to my roots of graduating law school in 2009 and seeing that the people who got terminated, the attorneys that got let go or laid off, were not the attorneys with big books of business. Those attorneys always have a place. And so if you have clients, if you have relationships, you have people who know, like, and trust you, and come to you to do work for them, you always have a place anywhere you want. Or you could write your own ticket by starting your own firm. And the firm I was at was a great firm, great attorneys, loved it there. The problem was that I was the corporate guy doing all the corporate work for other people's clients. And so at the end of the day, my risk was, as I look back at it now, it was more of a risk for me to be there than it is now, because now I have my own clients. I have those relationships, direct relationships. And when they have issues, they come to me. And so I can write my own ticket a lot more than I could at the prior firm. And so I think, often people think that whatever society says or whatever seems normal and safe might not always be normal and safe, because big Fortune 500 companies will lay you off, and that happens all the time. And so just having that job doesn't necessarily mean you're safe. And so I think bottom line is, sometimes take what seems like a risk might actually be safer in the long run.
No, well said. I think there's a lot of people out there that believe if you have, or there's security with a job. I think it's kind of a lot of the way we've been, our society is kind of reflected. You go back a couple generations, and you look for the union label or whatever you want it was, and just kind of the comfort, I think, is probably too a part of that. Is that a lot of times the jobs, they give you just enough to satisfy you, but keep you hungry, not so much you're not hungry, kind of thing. And you don't realize what's on the other side of the fence. And then the flip side of that is, a lot of times the opportunity always looks, or the grass always looks greener on the other side of the fence, but it's just as tough to mow, kind of thing. But that's great. I mean, again, I commend you on jumping out on your own, and congrats on your success. So
thank you. Appreciate it.
Hey, Trevor, before we wrap up, where can the listeners go if they would like to learn more or connect with you?
So my website is www.crow.legal. And so it's not a .com, it's .legal. And so CROW.legal. And so all my information's on there, but you can feel free to email me at trevor@crow.legal. Happy to talk to anybody who's looking to do a deal or whatever, even if you just want to chat about it and bounce ideas. Happy to do that. We don't charge for anything like that or initial consultations. We want to make sure we're the best fit before you ever receive a bill from us. And my direct line is 720-230-7123. You could call me there as well. And so feel free to reach out anytime.
All right. Well, Trevor, I can't say thanks enough for taking the time. I've enjoyed our talk, learned a lot, and hope we can do it again soon.
Sounds good, Darren. Thank you.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.